The bond market isn't just wobbling. It's sending signals that most investors won't recognize until it's far too late. And when sovereign debt, the so-called risk-free foundation of the entire financial system, starts cracking, gold and silver don't politely climb, they explode. But here's what almost nobody is discussing. The trigger isn't coming from the metals market itself. It's loading right now in a place most people consider boring, a place where trillions in collateral sit, where central banks have no choice but to respond, and where a single week of chaos could reprice silver in a way that makes today, as numbers, look like a clerical error. The question isn't whether this happens. The question is whether you'll be positioned before the crowd realizes what just hit them. Welcome to boring currency analysis. Now, I realize the name might not sound thrilling, but if you've been around long enough to understand that the most dangerous financial moves happen in the places nobody's watching, then you're in the right place. We don't do entertainment here. We do strategic economic warnings for people who make real decisions with real capital. If that resonates with you, I'd appreciate it if you'd subscribe. Not for algorithm games, but because when the next phase of this cycle unfolds, you'll want these insights in your corner. And do me a favor, drop a comment right now telling me where you're watching from. Whether it's New York, London, Dubai, Singapore, I'm genuinely curious who's paying attention while the rest of the world is distracted. Now let's get into what's really happening. If you're holding gold or silver right now, there's something you need to understand. The next major move in precious metals won't come from a mining shortage. It won't come from a celebrity endorsement. And it won't come from some dramatic headline about stockpiling. The real trigger is sitting quietly in the bond market. And most people have no idea how dangerous that actually is. Here's why this matters. Bonds aren't just investments that retirees buy for steady income. They're the plumbing of the entire financial system. They're the collateral that banks use to prove they're stable. They're what pension funds park money in when they want to show regulators they're being responsible. They're what the system treats as the closest thing to risk-free. So when bonds start behaving strangely, when prices drop and yields spike in ways that don't make sense, the entire concept of safety gets questioned. And when safety gets questioned, people don't calmly adjust their portfolios. They panic. Now, let's look at history for a moment. In past financial crises, the problems came from specific corners of the market. The tech bubble burst in 2000. That was painful, but it was contained to overvalued stocks. The housing market collapsed in 2008. That poisoned bank balance sheets and froze credit markets. But those were still manageable in a certain sense because they didn't directly threaten the foundation. This time is different because this time the stress is building in government bonds, the very thing that's supposed to be the foundation. Think about what that means. When the so-called risk-free asset starts wobbling, there's nowhere left to hide using traditional thinking. And here's the part most people miss completely. Bonds don't need to crash dramatically to cause massive problems. A sharp drop over just a few days is enough to light a fuse, because bonds aren't just held by passive investors. They're used as collateral in lending markets. They're held with leverage by institutions that borrow against them. So when bond prices fall, the collateral value drops. When collateral value drops, lenders demand more cash or they pull back entirely. And when lenders pull back, you get a chain reaction that looks calm on the surface until suddenly it explodes. There's a corner of the market most people have never heard of called the repo market. It's where institutions borrow overnight using bonds as collateral. It's the heartbeat of daily liquidity in the financial system. When bond prices fall sharply, that heartbeat gets irregular. Borrowers have to post more collateral, lenders get nervous and tighten terms, and in a matter of days, liquidity that everyone assumed would always be there simply disappears. Now, this isn't just a domestic problem. Bond market stress travels across borders. Foreign governments hold trillions in U.S. Treasury bonds. Pension funds around the world use bonds to match their long-term liabilities. Insurance companies rely on bond yields to fund payouts decades into the future. So when bond prices start moving erratically, these massive institutions have to rebalance. And when they rebalance, the ripple effects hit everything. Here's what makes this situation particularly dangerous right now. The first sign of real trouble usually isn't a dramatic crash. It's a weird day where things stop behaving normally. An auction that doesn't attract enough buyers. A sudden spike in long-term yields that gets blamed on positioning. A gap in prices that nobody can quite explain. Those are the early warnings. The market is quietly telling you that demand for government debt is weakening. And when that happens, policymakers face an impossible choice. They can either let yields keep rising and watch the pain spread throughout the economy, or they can step in and add liquidity. Let me translate that into plain language. They either let the pressure build until something breaks, or they start printing money to calm things down. And here's the critical point. When central banks step in to support bond markets, they're not doing it with existing money. They're creating new money, new credit, new liquidity, whatever polite term you want to use for it. And when that new money floods into the system, it has to go somewhere. It doesn't just sit still. And the first places it flows are the assets that can't be created with a keystroke. Hard assets, real assets, things like gold and silver. Now, here's where the timing gets interesting. The bond market stress doesn't give you weeks of warning. It builds quietly. Then it moves fast. You might wake up one Monday morning and see yields jumping. By Tuesday, credit markets are tightening. By Wednesday, policymakers are holding emergency meetings. And by the time the weekend comes, new liquidity programs are being announced. That's when gold and silver don't gradually climb. They gap higher. And if you're waiting for a polite invitation to enter the market, you'll miss the move entirely. So the question you need to ask yourself is this. Are you watching the bond market at all? Or are you waiting for the chaos to show up in headlines? By which time the easy gains are already gone, because the foundation is cracking. And when the foundation cracks, everything built on top of it starts to shake. Now that we've established the bond market is the trigger, let's talk about what happens when that trigger gets pulled. Because most people assume the response will be slow and predictable. A gradual rise in gold prices, maybe some safe haven buying, nothing too dramatic. But that assumption misses something critical. Silver doesn't behave like gold. It doesn't move with dignity. It doesn't climb politely. Silver is the asset that sits quiet for years and then detonates. And right now, silver is sitting in a position that historically precedes those detonations. Here's what you need to understand about silver's structure. For most of recorded monetary history, silver wasn't gold's inferior cousin. It was gold's partner. Both were money. Both were held by governments. Both were used in daily commerce. The ratio between them stayed relatively stable for centuries. Roughly 15 ounces of silver bought 1 ounce of gold. Sometimes 10, sometimes 20. But it moved within a range that made sense. Then modern financial markets arrived. And that ratio stopped making sense. In recent decades, we've seen the gold to silver ratio swing wildly. At times, it's taken 70 ounces of silver to buy 1 ounce of gold, sometimes 80. In moments of extreme stress, it's spiked even higher. That's not a reflection of silver's value. It's a reflection of silver being psychologically abandoned, treated as the metal that never quite delivers, the one that gets hyped and then crushed, the one that people eventually give up on. But here's the pattern that keeps repeating. When stretched relationships snap back, they don't return to average and politely stop, they overshoot. Because markets aren't driven by logic, they're driven by human emotion, and emotions swing from one extreme to another. Think of it this way. Gold has been running steadily for years, making new highs, gaining respectability. Central banks openly buy it. Institutions acknowledge it. Nobody laughs at gold anymore. Silver, meanwhile, has spent years tripping over itself, consolidating, getting ridiculed by investors who think it's a relic. But history shows that silver doesn't stay humiliated forever, and when it finally breaks out, it doesn't move 10 or 15%. It moves in ways that make people's heads turn. Now, let's talk about why this time could be different in terms of magnitude. Silver isn't just a monetary metal anymore, it's also deeply embedded in the industrial economy. Electronics rely on silver for conductivity. Medical equipment uses silver for antimicrobial properties. Water purification systems depend on it. And here's the big one that most analysts underestimate: solar panels. As countries push toward energy transition and electrification projects, silver demand isn't optional, it's structural. You can't build solar infrastructure at scale without it. So you've got investment demand potentially surging at the same time, industrial demand is rising. And that creates a problem. Because silver supply doesn't respond quickly, most silver isn't mined directly. It comes as a byproduct of mining other metals like copper, lead, and zinc. That means even if silver's price doubles, you don't instantly get a flood of new production. The pipeline is slow, the lag time is long. Meanwhile, the available supply that investors can actually access is thinner than people realize. A lot of silver is already embedded in products. It's sitting in supply chains. It's held in forms that don't immediately come back to market. So when investment demand suddenly spikes, the float that's actually available can feel shockingly small. And that's when you get repricing events that catch everyone off guard. Now, let's talk about market psychology. Because this is where silver becomes truly dangerous for those who hesitate. When silver first starts running, most people don't believe it. They call it a fake out. They say it's overbought. They assume it'll get slammed back down like it always does. And yes, silver does get slammed. That's part of its personality. But the bigger risk isn't getting shaken out during a pullback. The bigger risk is waiting for the perfect entry that never comes, and then watching silver rip higher without you. The move typically happens in phases. Phase 1 is quiet accumulation. The diehards buy. Nobody else cares. Phase 2 is the initial breakout. People argue about whether it's real. The market shakes out weak hands with a sharp correction. Phase 3 is when the move becomes obvious. The crowd starts showing up, FOMO begins to build. Phase 4 is when it turns into a headline. That's the blow-off phase. That's when people who've never thought about silver in their lives suddenly want in, and by then, the easy money is gone. Here's the cliffhanger most people don't consider. If we're entering phase 2 or 3 right now, the most confusing part is that you can still get a brutal mid-run pullback, a drop that convinces everyone it's over, right before it launches again. And that pullback might not happen at an obvious technical level. It might happen at a price that feels so absurd it forces everyone to talk about it. That's the shakeout that separates casual interest from real conviction. So ask yourself this. If silver suddenly printed a price you never expected, would you feel excitement or regret? Because the next phase is loading, and it won't wait for you to feel ready. There's a third layer to this story that most investors completely overlook until it's already running. Mining stocks. Now, before you roll your eyes and think this is just another pitch for penny stocks, let me explain why this matters from a purely structural standpoint. Because mining equities aren't just companies that dig metal out of the ground, they're leverage on top of leverage. And when that leverage activates, the moves can be more violent than anything happening in the physical metals themselves. Here's the basic math. When the price of silver rises, a mining company's revenue rises with it, but many of their costs are fixed in the short term. Labor contracts are already signed, equipment is already purchased, energy agreements are locked in. So if silver moves from $70 to $100 per ounce, the company's revenue doesn't just increase by 40%. Their profit margins can double or triple because the incremental revenue falls almost entirely to the bottom line. That's operational leverage. And when that operational leverage shows up in quarterly earnings, equity markets start paying attention. But here's the problem. Mining stocks have been burned before, badly. In past cycles, miners got reckless. They overpaid for acquisitions. They diluted shareholders with endless stock offerings. They chased marginal projects in unstable jurisdictions. And when metal prices eventually rolled over, those companies got obliterated, so an entire generation of investors learned to hate mining stocks. They treat them like lottery tickets at best, and outright scams at worst. And because of that distrust, mining equities have spent years trading like nobody believes the metal price will hold. Even when gold and silver have been rising, many miners have barely budged. The market is essentially saying, we've seen this before, and we don't believe you. But here's what's changed. Many of these companies have cleaned up their balance sheets. They've paid down debt. They've become more disciplined about capital allocation. They're not the same reckless operators they were a decade ago. Not all of them, of course. Plenty are still traps. But enough have reformed that the sector as a whole is undervalued relative to metal prices. And that creates an opportunity. Because when the market finally believes the metals move is real, when it stops treating gold and silver like temporary spikes that will fade, that's when capital rotates into miners seeking torque. And that rotation happens in stages. At first, when metals start rising, miners lag. Because investors assume it's another fake out. Then miners start catching up. Slowly at first, then faster. And that's when the trade becomes real to equity investors. Once mining stocks break out and hold those breakouts, generalist money starts flowing in. These aren't precious metals specialists anymore. These are equity fund managers who see momentum. They see relative strength. They see a sector that's outperforming while the rest of the market is struggling, and they allocate accordingly. That creates a feedback loop. Rising stock prices attract more attention. More attention brings more capital. More capital pushes prices higher. And suddenly, you have a self-reinforcing cycle that can last months. But there's a massive warning you need to understand. Miners are not the same as physical metal. They're businesses. They have execution risk. They operate in different jurisdictions with varying degrees of political stability. They face cost inflation, labor disputes, regulatory changes, and environmental challenges. So you can't just buy anything with gold or silver in the name and assume it's going to work. That's why thinking in tiers makes sense. Tier 1 is the large, established producers, strong balance sheets, proven assets, low political risk. These are the companies that institutional money feels comfortable owning. Tier 2 is the mid-tier producers, higher growth potential, slightly more risk, but still operating real mines with real production. Tier 3 is the explorers and developers. These are high-risk, high-reward plays. They don't produce anything yet. They're betting on discoveries or development timelines. And if you don't know what you're doing, they can wipe you out. So the strategy isn't to blindly buy the sector. It's to understand where you are on the risk spectrum and position accordingly. Now, let's talk about what happens if the broader stock market rolls over while this is happening. Because that's the scenario that confuses most people. If we get a serious equity drawdown, you might see mining stocks dip too, even if metal prices are rising. Why? Because in a liquidity event, people sell what they can to meet margin calls. They don't sell what makes sense. They sell what has liquidity. But here's the difference. When metals are in a genuine bull phase, miners recover faster than the general market because capital starts seeking exposure to the thing that's actually working. So you can end up with a situation where the S&P 500 is down 20% and mining stocks are up 50%. That disconnect drives people insane. They'll say, how can miners be rallying when everything else is collapsing? The answer is simple. Capital goes where the oxygen is. And if the oxygen is in hard assets and commodity-linked equities, that's where the money flows, regardless of what's happening elsewhere. Now here's the final cliffhanger for this section. If bond market stress forces central banks into emergency liquidity mode, and if that liquidity pushes gold and silver into a sustained bull run, do you think the first wave of capital flows into physical bars and coins? Or does it chase the mining stocks because they're faster and easier to trade? That answer determines whether the next leg is explosive or absolutely parabolic. Because when generalist equity capital discovers a sector that's working in a market that's broken, the chase becomes relentless. And the companies positioned at the top of that momentum wave don't just double, they can multiply several times over in a matter of months. So the question is, are you watching mining equities at all? Or are you waiting for the headlines to confirm what's already happening? Let's bring all of this together. Because the bond market trigger, the silver supply squeeze, and the mining equity leverage all point to the same underlying reality. And it's a reality most people refuse to acknowledge until it's staring them in the face. The purchasing power of currency is deteriorating, not temporarily, structurally. And once you understand that, everything else makes sense. Now, this isn't a political statement. It's not about which party controls government or which central banker is in charge. It's simple math. When you operate a debt-based monetary system, and when that debt keeps growing faster than the economy, the only way to manage it long-term is to make the debt easier to service. And the easiest way to make debt easier to service is to devalue the currency it is denominated in. That's not a conspiracy, it's policy. It's been the playbook for decades. And it will continue to be the playbook because the alternative, allowing defaults and deflationary collapse, is politically unacceptable. So here's what happens. When bond markets get stressed, central banks face a choice. Let yields rise, let financing costs spike, and let the pain spread through the real economy, or step in with liquidity. Every single time in recent history, they've chosen liquidity. They call it market functioning, they call it emergency support, they call it temporary measures. But the effect is the same. New money enters the system. And that new money doesn't increase the amount of goods and services available. It just increases the amount of currency chasing them, which means prices adjust, sometimes slowly, sometimes all at once. Now, let's talk about the dollar for a moment, because people get confused when they see the dollar index holding up or even rising. They think, how can the dollar be losing value if it's strong against other currencies? Here's the problem with that logic. The dollar index measures the dollar against a basket of other major currencies: euros, yen, pounds, Swiss francs. So if those currencies are being debased too, the dollar can look strong on a relative basis, while still losing purchasing power in absolute terms. You don't feel that in the currency charts. You feel it at the grocery store. You feel it in insurance premiums. You feel it in the cost of housing, education, healthcare, energy. Anything that requires labor, materials, or real resources keeps getting more expensive. Not because those things became more valuable, but because the unit of measurement got weaker. And if you look at broad money supply over the past few years, the picture becomes clear. Massive expansion during crisis periods, some contraction afterward. But the overall level remains far above where it was before emergency policies became normalized. That money doesn't just disappear, it sits in the system. And over time, it works its way into prices. Now here's where this connects to the bond market. If bond stress becomes severe enough that central banks have to intervene aggressively, that intervention, by definition, means easier financial conditions. Easier financial conditions mean more liquidity. More liquidity means weaker purchasing power over time. And weaker purchasing power pushes investors toward assets that hold value across different monetary regimes. That's the cycle. That's why gold and silver keep coming back into the conversation every time confidence wobbles. They're not speculative bets. They're responses to a system that has no reverse gear. Now, let's get practical. Because understanding the theory is one thing, positioning correctly is another. If you're already holding gold and silver, the key is discipline. Don't let daily volatility rewrite your long-term thesis. Watch the bond market, watch policy signals, watch real yields, not nominal ones. Watch how central banks respond when stress appears. Those are the indicators that matter, not what some talking head on television says about whether metals are overbought. If you're not in metals at all and you're skeptical, that's fine. Skepticism is healthy, but don't confuse skepticism with denial. Build a framework so you know what signals would change your mind. Because when those signals flash, the window to act closes fast. Here's a simple 3-signal confirmation model you can use. Signal 1, bond yields spike and don't fully retrace. That tells you something structural is shifting in the demand for government debt. Signal 2, credit spreads widen even when stocks are still holding up. That tells you stress is spreading beyond just government bonds into corporate borrowing costs. Signal 3, physical metal demand absorbs pullbacks quickly. That tells you the crowd is starting to position, not just speculate. When all 3 of those signals flash at once, that's your hint. Something big is loading, and if you've been waiting for a headline to give you permission, don't. Headlines arrive after the move. They confirm what already happened. They don't predict what's coming. So position first, let the crowd learn the hard way. Now, let's talk about profit taking, because this is where people make critical mistakes. If silver does have a blow-off move, it won't feel safe. It will feel insane. It will feel like it's about to crash every single day. And that's why most people won't capture the full move. They'll sell too early out of fear. Then they'll buy back higher out of FOMO. Then they'll sell again when it dips. And they'll miss the final leg entirely. The solution isn't to hold blindly and hope. It's to have a plan. Decide in advance at what levels you'll take partial profits. Not all of it. Just enough to lock in gains and reduce emotional pressure. That way, if the move keeps going, you're still participating. But if it reverses, you've already secured something. That's not weakness, that's survival. Now, one more layer. This isn't just a US story, this is global. Major economies around the world are carrying heavy debt loads. They're all facing demographic challenges. They're all dealing with productivity slowdowns. And they're all facing the same temptation. Keep financing easy, keep the system afloat, kick the can down the road. That means currency debasement isn't isolated to one country, it's synchronized. And in a synchronized debasement environment, hard assets become the common denominator. That's why you see central banks quietly accumulating gold, even while they publicly downplay its importance. They don't hold it for nostalgia. They hold it because it's outside the paper promise system. And when the public starts remembering that, the move becomes unstoppable. So here's the final question. When sovereign debt markets force policymakers into a choice between systemic pain and liquidity expansion, which side of that decision will your capital be positioned to benefit from? Will you be holding assets that depend on promises being kept? Or will you be holding assets that have value regardless of what promises get broken? That's not a rhetorical question. It's the strategic decision that separates those who navigate the next cycle successfully from those who watch it happen and wonder why they hesitated. Before you go, let me be clear. Everything discussed here is for educational purposes. This is perspective, not personalized financial advice. I don't know your situation, your timeline, or your risk tolerance. So don't treat this analysis as a custom plan. Use it as a starting point. Build your own framework. Make your own decisions. And if you find success with your strategy, share it in the comments. Those stories help others stay calm when markets get chaotic. Now tell me, are you watching bonds at all? Or are you still only focused on stocks? And are you holding more gold, more silver, or neither? Drop your answers below. And remember, the foundation is cracking. The question is whether you'll notice before the crowd does.